Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
And the right side of this file, which we don't see anywhere in the near term, is the dollar appreciates on U.S. growth, meaning outsized U.S. growth compared to its competitors. We may be very, very wrong. Maybe the stimulus the government stimulus we've thrown into the market has lagged, and it's going to kick in pretty soon, and U.S. growth will hike up and surprise us in a big way, meaning the expectations will also change coming from the Fed, and interest rates will start to be marked up in the U.S. We don't see that in the near term, but it's a possibility, and on that score, the U.S. dollar's here. We just think that, the two possibilities are this and this, either at the bottom of the smile or on the left side of the smile, and given what's happening in Europe today, we're leaning towards this idea the dollar rallies on risk as it has today. I think I've shown you this near-term current account correlation, and one of the things I also want to talk about, as I said earlier, is this interesting correlation between gold and the U.S. dollar. This is only since 2008, but if you go back and look at long-term gold versus U.S. dollar charts when the dollar started floating in 1971, or all the major currencies came off the Bretton Woods system and started to float, you saw a very precise mirror image correlation with gold going up and the dollar going down, or dollar going up and gold going down, and that correlation makes some sense. Since gold is priced in dollars as the world reserve currency, as the dollar goes down in price, the relative price of gold goes up in order for it to maintain its purchasing power across the global basket of goods. If gold is the standard, the center standard still as real value across the world, and because it's priced in dollars, as the dollar goes down, it has to go up, and that's why that mirror image has been intact for that period. It makes some sense. But what we're seeing happening now, and you can see it started really right in here, and hopefully you can't hear my dogs barking. I have my two dogs come there in the office with me every day. They're howling like crazy. I apologize. As you can see from this period on, and this is really where the systemic risk in a big way started to flow into Europe, where we really got a picture, or at least a suggestion, more people in the world got a suggestion that the euro could come apart, and a lot of that portfolio money started flowing into both the dollar, we think, and gold at the same time, and and we're seeing that correlation play out, which is very interesting, and we think this is very much part and parcel to the whole European banking system problem going forward. So it's something that we're watching very, very closely as an indicator going forward, that trouble for the euro in a very, very big way. And this idea, again, of gold going up and the dollar going up just, I think, reinforces this idea that the dollar, now when it's moving in conjunction with another major risk asset in the world, is becoming more and more demand at a time when the global economy looks more and more shaky, which, again, most analysts say gold's going to go up and dollar is going to go to zero. Be very, very careful with that call again. And there's some additional information where to find us. Our Currency Currents professional, as Steve said. We also have a free morning newsletter you can sign up for. And this is our managed currency program that we just started. Had a pretty good month in August, and we're starting to get more and more funds into our program. And if you want some information about that, we'll be happy to give that to you. And Steve, that's it for me, and we'll open it up for questions, hopefully. See. Can everybody hear me okay? Happy to take your questions. Great. Let's see. One of the questions was, where do we see the BRIC countries in this scenario? Well, we see from the BRIC countries, if the U.S. muddles along And China keeps the music playing. The BRIC countries, we think, continue to do just fine, because the global liquidity will be there as the Fed continues to pump money in the world. China demand stays intact. The BRIC countries continue to be very, very supportive. In time, those BRIC countries, which really is the emerging markets in general, will get more and more money flow in the world. Even if we get a dislocation here, ultimately, unless something happens, something just very, very nasty happens in the world economy for many years, ultimately we see that money just naturally shifting in a very big way to all the emerging markets, just given the relative growth, and we surely think, given what the industrialized world has done to their own balance sheets by trying to provide Keynesian stimulus, we're going to have many, many years of subpar growth in Europe, in the U.S., and we already see it in Japan. That means those areas that have deep capital investments, that are really the pool of global capital, those investors will continue to move offshore in the emerging markets because the growth opportunities won't be there domestically, and that transition, especially as the emerging markets, the BRIC countries, build the capital, the depth of the capital markets, we think that shift will move even faster and faster, and the role of the BRIC currencies will hike up pretty quickly over the next 10 years. What effect will the midterm elections have, if any? We're not sure. I mean, we'd be guessing as everybody else would. You know, it sure looks like the Democratic Party is going to take it on the chin in the midterm elections, but we just wonder how much change there's going to be at the fiscal level. We're not sure if it makes any change, if the elections make any change on the monetary side of the fence, fiscally or out of bullets. We'll just have to see. So it's an area we could discuss for a while, but I don't think it's any area where we have any better insight than anybody else. If we see big changes on the tax front, meaning and regulatory front, but would probably be vetoed from the administration still. It could be kind of a stalemate. So it's hard to say we're going to see any great positive changes from it. Dollar versus yen, what do you see in this pair? Well, near term, we continue to peck at the yen, thinking it's going to really start weakening, and we've been wrong. Long term, our view is this, that the yen is extremely overvalued against every major currency in the world. And we say that because of the fact that we think Japan is getting very, very close to the point where they're no longer going to be able to fund their debt domestically. And when that happens, it means they're going to have to raise their interest rates in order to create funding. And when they raise interest rates, that's going to be a big problem because the revenues to the Japanese government have fallen sharply. So you're going to see an increase in the cost to fund their debt at a time when their demographics are getting worse and the revenue to the Japanese economy is falling. And we think finally at that point they're on a big way on the Japanese yen. So we have a call of $125 yen, over the next couple of years, I guess I would say. But ultimately, we're very, very negative on the yen, and we think that's going to be the next major big trend trade in the world, in fact. But near term, we've been very, very wrong. But sooner or later, it'll play out. And I think one of the things to watch, at least what we're watching, is the long-term bond yields in Japan. Watch the 10 and 20-year bond yields in Japan. If they start to rise, because the Japanese savings rates are now about to cross over zero into negative territory. Most people think Japanese are big savers, but because of the decline in income for many, many years in the last decade and the aging of the population, they've drawn down on those savings, and that means they're not going to be able to fund that stuff domestically anymore. So those high debt to GDP ratios, we think, are finally going to roll into the yen.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.